Hi, everybody. It's Faisal here. I've got my good friend, Mark Figueredo. He's a area mortgage specialist with the RBC. And just following today's announcement, I thought it would be timely to have Mark come on and tell us what the Bank of Canada has announced, how that impacts first-time homebuyers, investors, anybody who's renewing their mortgage. Welcome, Mark. I know I didn't give you a lot of notice today, and I really appreciate you taking some time out of your day today to join me and explain to us what's going on with this new rate increase, and is it what we expected? Shed some light on this.
Yes, thank you. Thanks a lot for having me, Faisal. Yeah, it was. It is a little bit more than we expected. I think we expected an increase. I think the Bank of Canada has given us some guidance that they were willing to do a little bit more, a little bit front loaded, which it looks like they have. And I'm not going to lie to you, I've had a few hours to digest and sit on it a little bit. I'm a little bit more shocked this morning, but it does look like they've taken that plunge to try to fight off inflation. So definitely some effects that are gonna come out of this with our first-time home buyers and our purchases and anybody who really holds a mortgage, but really whoever holds a variable rate mortgage currently will be affected as of tomorrow. So as of overnight tonight.
So, what will the variable mortgage rate be for someone who's got a variable mortgage?
So the prime rate today, before this announcement, was 3.7, and a variable rate mortgage is normally a discount off of that prime rate, and the prime rate will be increasing a full percentage point to 4.7, and then you get your discount. And depending on when you got your mortgage, it could be anywhere from prime minus a half to prime minus one. So you're going to be still relatively cheap in the whole overall, but it starts to get a little worrisome as rates continue to increase.
So, if one was to get a 5-year mortgage today,
Yes.
a fixed mortgage, 20% down, what would their rate be based on today's rate announcement?
Yeah. So it depends. Well, the rate announcement wouldn't affect it directly the fixed rate market immediately. So there may have lingering effects that happen in the coming weeks. I would say, depending on your on the term when you locked in, I would say you're probably in the low fives, five and a quarter, depending on amortization and things along those lines. If you have high ratio mortgages, which are less down payment, the rate's actually a little bit lower, maybe just below five. Um, but what it's going to start to really affect going down the road is your qualifying rates. So what we've had is the government in 2018 implemented a stress test. A lot of people know what it is, but it's a mechanism that adds 2% to your rate for qualification purposes. So people have been hiding in the variable space for the last little bit because the rate was a lot lower. So the stress test really hasn't been affected if you were going variable versus fixed. But now with the variable rate increase, it's really going to start to erode your your borrowing capability. So it's
So,
going to.
correct me if I'm wrong. If the rate is, let's say, 5% for a 5-year rate, you have to qualify as if it's 7%. Is that the right number?
Correct. That's correct. So the minimum at 7% would be 2% above your rate, and then with today's rate of variable at 3.7, we'd be qualifying at 5.7. Tomorrow we're qualifying on a variable at 6.7. So now that's come up to really close to where the fixed rates stress test is.
Okay, so crystal ball question here. Do you expect that we're going to have another rate increase coming up in the next quarter, in the next month? When would you expect the rates to increase? And where do you think we're going to be by the end of this year before it tapers off, or at
Before
least?
we peak. So what I'm reading and what I see happening, I think a lot has to do with inflation. So that's the scary thing about right now is I don't think anybody knows where the top is. If I was to say worst case with what I know, probably we're going to have another couple increases, maybe a quarter, half. We should start to see them taper off to smaller increases going forward. Then we also run the risk of inflation, or of a recession. So we raise rates too fast, too quick, and then it slows the economy down too much. And then we may have to adjust back the other way at some point in the future. So it's not always up, not always down. But I think it's a game of trying to soft land this so that we're not heading into recession. But I'd say probably another 0.5% with what I know now. Maybe at the top, I think the peak, what I'm reading, maybe 3.25, going up another 75 basis points from where we are now. at the worst.
So it could hit close to 6%, 6.25 on the lending side on a 5-year rate before too long is what you're expecting.
Well, on the fixed rate term, it's weird because a lot of the rates are not linked towards variable; they're linked towards the bond market. So the bond market is already included a lot of these increases. To be honest, when they announced this rate increase today, I was expecting more movement in the bond market because it would surprise the market. I don't think people were really anticipating 1% increase. It hasn't yet. So I think there was an expectation that this was going to happen. More than what we originally thought. So we probably going to have some increases, but I don't think that it's going to be directly linked to the fixed rates. The fixed rates have already moved substantially from troughs of January. Right?
Yeah, so we've seen in the real estate end of things, and tell me if you've seen this on your side from an appraisal perspective, where end of February, beginning of March, we had peaked at the top that we've ever seen historically in real estate values in this region anyways. Every time I've seen a rate increase, I've seen the market, and that's based on 0.5% to 0.75% increase. I've seen the market price of a home drop by about 10%. So homes that were appraising close to 1.2 million in February, at the end of February, they're appraising around 950 right now. Now, are you seeing people who had purchased, say, back in February that have got closings coming in mid to end of July? Are you seeing any trouble in that area?
At RBC, we're not. We appraise right away. So we have had some clients approach us from other institutions who waited to do their appraisals. I think it's a great point to bring up, though. I think we've been in such a downward trend on interest rates that we have to change the way we think about rate holds and appraisals and things, because you can get yourself into trouble if you wait too long because the market changes, right? So we've seen it happen in the last few months. We've seen rates decrease or increase and values come down, and we've had people come back 2 months, 3 months later and not get the values that were originally bought, and they probably would have appraised well 2 months ago. So we have seen those issues come up. We appraise right away. That's the first thing we do. We don't wait till 2 weeks before closing. Even on new builds now, we appraise 2 years in advance. So just to take away that risk.
So if I came into you, purchased a home today, you would send out the appraiser and you would give me a RBC, I think it call it a firm approval. Yep. And that means that regardless of the market changing, loss of employment or employment change, once you've given me that approval, if my closing is 3 months down the road, I'm safe. I don't have to go through another qualifying process.
Correct. That is 100% correct.
Okay, that's good to know. Yeah, because we've seen a lot of people. Well, of course, now if they bought back in February and didn't come to you until last week for a closing that's happening end of July, you're going by current appraised value.
Correct.
Okay, and at that point, it is what it is. We've seen that happening, and we're certainly seeing a lot of renegotiations happening where people are having to take a little bit of a haircut on the value that they got back in February or March, just to make sure the deal closes and try to shorten that gap so that there's no lawsuits lingering around. Now, do you expect that the investor market will also be affected by these rate changes? Is there a different rate for investment properties than there is for principal residence?
For us, there's none. There's no difference in rates. I actually see it as an opportunity. I think what's going to happen with prices coming down, these investors are coming back, and I have a lot of investors coming back to look at, because rents are very stable. Rental, again, you'll know better than me, but up to this point, rents have been very stable. If prices come back to a certain point, those people are coming back to the market. So I think we're approaching, if we're not already there, we're approaching that spot. I would say people are going to buy houses. You know this better than anybody. I think they may delay the decision for 3-4 months, but at some point the demand is still there. So I think it's still a pretty good investment. We don't add rates to investment properties. Whether it's a primary res or not, there's no increase in rates due to that.
Now, speaking of investors, let's say I've got my principal residence, I want to now deploy some of the money that I've got in my principal residence. I come to you, you give me a line of credit, and that line of credit would be based on a variable, I'm assuming.
You have the option. You could take a part of it as a fixed rate, a variable rate, or a line of credit. Yep.
Okay. And how many properties am I able to own? Um, is it with your bank, let's say, or just in total? Is there a difference?
Yeah.
Can I come to you and get 3 mortgages and go to another bank and get 5 mortgages and keep doing that? Or am I limited to how many mortgages I can have as an investor?
That's a great question as well. Our policy is nine doors. It doesn't matter where they are, right? So it doesn't matter where they are. You also 5 rentals, and then you have your primary residence. You can have cottage, and there's always case by case. So then case by case, that's the policy. We would look to assets
So
and other
when
things.
you say it doesn't matter where they are, do you mean geographically or which bank they're with?
With the banks they're with. So 9 properties in total. It doesn't matter if they're with another institution or an RBC. That would still count as one of those 9.
You look at my portfolio of ownership and then, okay, you're up to 9. That's the cap on the number of properties one can own.
Yes, under the residential platform. So then we have also commercial. Yeah, and we do have alternate lenders that we can turn to as well. That could help and assist if you want to build your portfolio on the residential side. Past that,
Right.
really case by case. Yeah.
Right. Well, I totally agree with you, that this is probably a pause right now in the marketplace. We're seeing rental rates just skyrocket because well qualified individuals with good incomes are sort of sitting on the sidelines, saying, well, we're going to wait for the market to continue dropping before we enter. But the flip side to that is that the rates have been increasing. So essentially, their payment hasn't really changed. Yes, they might be able to buy a home for less money, but they're going to pay the same payment that they would have if they paid a little bit more money at a lower interest rate. Is that what you're seeing?
That's 100% accurate. I say that to a lot of people. The only advice I'd have for any buyer, first time or multiple, if you're an investor, is be prepared. Get your pre-approval in. I don't think we really worried about rate locks that much in the last 20 years because we've
Right.
had decreasing rates. It's very, very important now. We've had people come back 2 months later and we have them locked in 2 months ago's rates, but they're buying in today's market. You can really take advantage of something like that where rates, property values go down a little bit, but your rate is from 2 months ago. It just really gives you options. That's the biggest thing right now.
Right. And like the fundamentals of the market and what was going on, say 5 months ago, it's almost like somebody's turned the tap off. But realistically, we're still in a housing crisis. We're still 1.5 million homes short in Canada, 500,000 homes short in Ontario. Immigration is at an all-time high. What, about 500,000 people coming in annually, and employment's at a high. And we've both seen some recessions in our lifetime. And I hate to use the word, but in your experience, do you see the same, is there the same sentiment around this recession or whatever you want to call it, this pause, as we did back in, say, 2008? And you're too young for this, but back in 1990?
Yes, I do. I think we're going to take people would call it a step back or a pause. Maybe we're breathing, but at some point, underlying problems are not fixed. At the end of the day, we have people coming in. We have, I think there's, in Canada, they're looking at million immigrants a year. We have population growth, and we don't have enough houses being built. So those starts are not enough. CMHC has come out with multiple reporting on that we're not going to be enough. We need to double and triple our capacity just to hit targets. So at some point, whether it's rental or whether it's to buy to live in, we're going to be short again, and people will re-enter that. They may be able to live with their parents for an extra 4 months, but at some point they're going to have to move out on their own, and then that's where the supply will evaporate really quick, I think, in my opinion.
Yeah, I agree with you. And as far as the housing starts, like I see that as a huge problem. land value has been purchased, developers have purchased land or builders have purchased land at an all-time high, as much as $15,000 a front foot. And that works out to a 40-foot lot, $600,000. Municipal fees, levies, regional, development credits, they're at an all-time high. And I understand they're going up even more so, despite what we were told as far as government relief coming. Getting permits, it's taking a long time. Construction costs has been at an all-time high, and I understand it's correcting a little bit right now. But when you put all that together, a 40-foot lot, 2,000 square foot home, if the land value is 600,000, to construct it, let's say $300 a foot, is another 600,000. So a 2,000 square foot home plus development charges, let's add another 50,000. So if the builder's cost is $1,250,000 for a 2,000 square foot home with a double car garage, would you say that that's going to be prohibitive compared to the resale value of a home? Because you could essentially buy a 2,000 square foot home with a double car garage today for under $1 million. Back in February, yes, it was 1.3, 1.4, and we've seen about a 30% drop. So how do we solve this problem? Because builders, I don't think, are going to be putting a shovel in the ground expecting to get 1.4 million for a home, and they're competing against the resale market. So what's the solution here? What do you think?
That's a great question. It's $1 million question, because to add to that issue is labor shortages, and you have union strikes and costs going up. If those costs get embedded, that's going to put a floor. The builders are not going to want to build, which is then going to make the problem ultimately larger or stick around for a lot longer. So I would agree with you 100%. We have to, in my opinion, we have to build more quicker. And I don't know if that's with these dynamics of what's going on. I don't know if it's possible to ask a builder to build a home virtually at a loss or to break even. I just don't think it makes any sense. So I think, they're going to sit on it and then make the decision later, or build a lot slower, because they got to keep their people working, but maybe not as quickly as they were maybe a year ago.
But won't that just continue adding to the housing crisis, the lack of inventory? And remember, there's, like you said, there's 1 million people coming into the country every year. Probably 500,000 of those end up in Ontario. Where are they going to live? And let's not forget, there's a lot of 25-year-olds that are living in mom and dad's basement that probably want to buy a home at some point or get out. Also, there's all of these tenants that are just sort of hanging their hat there for a year or so. So I would argue that this recession, if that's what we end up calling it, actually comes to pass, we're going to not last more than a couple of years, because people are going to have to get back into the housing market. And again, these increased rates, you're right, will cause us to go into a recession, because people are going to stop spending. If I've got to spend an extra $1,000 a month for my housing needs, which is essential, I'm probably not going to spend money in restaurants, on vacations and travel and shopping, retail, luxuries. So that's going to have a huge impact on our overall economy.
Correct. Yeah. And even if you throw in vehicles purchases, the larger purchases, those are definitely going to be something to watch on defaults on car loans and things on those, because that's the really the start of it all. I personally, again, I'm not an economist. I do, they had to do something to slow down the spending. We are getting to a point where it's going to start to push people to new limits they haven't seen probably in their lifetime. We've been around a little while. We've seen this happen. And then we're going to potentially see rates come down to offset if they overpushed. So we don't know until it's too late sometimes.
Well, it almost feels like a forced recession. Like they've created this situation where it's causing people to go into this. Now, do you expect that we'll see people entering, like, are you getting people coming in and qualify, asking to be qualified for mortgages like you were in the past, or has that slowed down right now?
Origination has probably slowed down. I would say the one weird thing is we've started to see clients that walked away from the market like 6 or 7 or 8 months ago walk back in now. So where they weren't able to do the bidding 30, 40 bids on one home, now you have a little bit more control. offers, maybe 2, 3 bids on a home. We have those clients coming back in now and trying to get requalified and start to look again. So it's really interesting. Some parts of it has come down, and then we have also the investors are starting to come back and kick tires as well.
Yeah, speaking of investors, I've been reaching out to my clientele base and saying, okay, the time is coming soon, and we're going to be putting on a investment seminar, which I know you'll be a part of as well, coming into late fall. And one last question before I let you go. I know you have to leave soon. What's your advice to first-time home buyers right now? Would you say wait until the prices come down a little bit more, or get into the market now before the rates continue to increase? So what would you say to a first-time home buyer?
I think depending on their situation now, where they are down payment credit wise, if they're living and they're paying rent, I would say it's an opportunity to look at it. Because if you're paying rent and you're paying $2,000 a month, we have options of different terms where maybe we're locking you to a 2-year or 3-year term, where we could take advantage of getting into the market now when the market's more favorable for buying. But I would say this, and I say this to everybody: be in the best position to make the best decision when the opportunity presents itself. Have the conversations, speak to the right people, and be ready when things happen. Because when things happen, you want to be ready to jump on them instead of waiting and having to come and do your due diligence after the fact, right? Have those rates guaranteed, have everything ready to go so that you can make the decisions a little bit faster.
Fantastic. So Mark, if anybody wants to get in touch with you, where would they reach out to you?
Yeah, they can reach out to me. Best would be my cell phone, 519-807-5698, or mark.figueredo@rbc.com.
Great. We'll post that at the bottom here as well, so people know where to get in touch with you. Thank you so much for your time, Mark. I really appreciate you taking your time out of your day to join me today.
No problem. Thank you very much, Faisal, for having me. Have a great day.
You as well. You take care.
Thanks.